We're live. Hi, sorry. Hi, Miles. Welcome to Venture with Grace.
Thanks for having me, Grace. Really good to see you again.
You too. Okay, so let's start with. Sorry, I have to insert a quick commercial because speaking of Kevin is our Kevin from Rockhouse VC is amazing firm, and then they actually sponsored our event, Smart Venture Media's first AI Summit. And then if you're in SF, please check our event page, smartventuremedia.com, to get your ticket. So we have over 30 speakers ranging from top VC firms to top AI startups. And if you're trying to learn more about AI, please click ASAP. Thank you. Okay, so Miles, let's start the show. Okay, so I want to
Big
start
fan of
with
Kevin Novak, by the way. Shout out to Kevin Novak,
exactly
one of our
shout out to
GPs.
Kevin. Love Kevin. Okay, so you started your career as at like First Republic Bank, and then now you're a VP of Crossover VC. Why don't we talk about what were some core lessons that you've learned early on in your career that kind of take you into who you are today?
Yeah. I guess just taking a step back there. There's no standard path to getting into venture. For context, we speak to about, or each one of our team members speaks to about 30 different GPs a month who are looking for capital, and everyone has a different story.
Mhm.
And if it wasn't for the 2008 financial crisis, I probably would have been a developer down in LA. But kind of streaming off of that, the only jobs that were available, kind of post 2008, were jobs that were in banking. And so, trying to figure out what happened to these defunct loans, trying to understand real estate values at that time. And so, that's where I really started my career off,
Mhm.
working at First Republic Bank for the head of credit, David Lichtman. I wore a suit every day into my job, which was fantastic. Paying off my student loans from USC, and just had a really, really awesome, great out of college experience at my first job. From there, for the next, call it 7 years, I moved around to different prop tech and fintech companies. Never a founder myself. I'm not smart enough to do that, but always a part of the early founding teams of various prop tech and fintech companies. And so, I wore a multitude of different hats, chased learning more than monetary value, and always wanted to work with people who were smarter, better connected, just really impressive people just to learn from. I think that's been a core tenet of my career and what I've been chasing. And then just by happenstance, Noah Lichtenstein, a friend, a networking friend I've had for a while, was also an investor in two of my last companies. So a company called Sundae Homes, which I led capital markets and secondary markets for. And then before that, he was an investor in Lending Home, which is now Kiavi. They've raised about 800 million from venture, doing incredibly well. Arvin's the CEO now. Speak really highly of that firm, but he was an investor in two of my last
Mhm.
companies and saw what I was able to do and build, and brought me over in 2022 to Crossover, and he launched Crossover in 2021. And so that's the background,
Mhm.
kind of how I got to where I am today. I
Mhm.
think, if I had to be honest, there are really just, I think, five key takeaways of like how I see career development, and the kind of things that, elements that got me to where I am today. And I think the first and foremost is hard work and determination. Um, I was fortunate enough to play water polo for USC, and win a national championship in
Mhm.
2008. And I want to be very clear here. The first team was national players and Olympians. The second team was national players, and the third team was me. So I want to be very clear on where I stood on the hierarchy. But discipline and grit and determination were just kind of pounded into you from day one. And I really took that mentality to work in each one of my career changes throughout my life. And so, what does that mean? That means getting into the office early, staying late, doing as much learning as I can outside the office and inside the office, asking a ton of questions, being very present, and just really giving it my all. And I think
Mhm.
people, my mentors, my bosses, really at the time, really just appreciated that insight and me having that ability to kind of grind and do and have that determination. I think, secondly, is that when you're going through the motions, success is, it's not a linear path. And I think anyone that you have on your show who is everyone's been super successful, or folks that you see on LinkedIn or Instagram,
Mhm.
everyone appears to have this linear path of success.
Mhm.
That every career pivot change brings, tons of money, tons of glory, and an updated LinkedIn profile, and everyone waves. And that's really not the fact. The fact is that it couldn't be more linear. And I think if you look at kind of a founder's path and how they,
Mhm.
the booms and the busts, it's very akin to anyone out there who's doing, kind of going through their career trajectory. And so I think understanding that out the gate, and understanding that, hey, you may be sitting in a path of, or for me, in a situation where I was operating in various fintech and prop tech companies, and after a while that wasn't becoming fulfilling and needed a career change and pivot, and spent, a year and a half trying to figure out what I wanted to do next. And that's very much part of the process. And so you take a step back in terms of pay, you take a step back in terms of title, to really reevaluate what you want to do in the next 5 to 10 years, and try to put your chips and yourself in places where you can really excel. So I think having that, like, kind of non-linear understanding is important. We talked about this earlier, but kind of just chasing learning over money, and I can't tell you how important that is. I think a big part of, how I got to where I am today is just surrounding myself with smarter people and continually to do so. I'm never the smartest person in the room, and if I am, that's a room I should not be in. And I really try to chase this learning more than I do kind of anything else, especially in my early career. Last thing I'll say is relationships are key. There's that old adage that it takes a lifetime to create a relationship and like a minute to burn it up. And I
Mhm.
can't say that it's incredibly true just within venture capital, within Silicon Valley, within San Francisco, and just within the world in general. And I can't tell you how many times that I wanted to, say some things to a superior, that may have come back to me and may have ruined that relationship. But I took the other approach, um, and really tried not to burn any relationships. And it's funny how the world comes around, and years later, I'll run into the same bosses or old bosses and colleagues who, definitely treated me horribly. But since I left on such good terms, they've actually become a reference, or they become an ally in my new job in ways that I could not find. And so I can't speak to that enough. Just do not burn relationships. And lastly, you got to take care of yourself mentally and physically. Kind of akin to that, mentality of grit and determination. If you're not taking care of yourself from a physical and mental standpoint, you can't take care of anyone else or your career. And so, yeah, I try to start my day off with either a run or a swim early in the morning, get some meditation in, just to really set myself up for success for that day. You can't let the day own you. You really have to control the day. And that waking up early and getting that quick sweat in, for me, has been pivotal to kind of how I've interacted and gone through my career.
For sure. I feel like the last one definitely hits hard because I feel like taking care of yourself mentally and physically is super important to have a sustainable career. By the way, I wanted to say hi to the audience. Hi, Vinish. Vijish. Okay. So I wanted to learn more about, like, okay, so I really like your career lessons about having a non-linear path, as well as, like, the reminder of like taking care of yourself. And I wonder, so like, maybe we start with like what is crossover VC, and then I know that you guys both do direct investing as well as like fund investment. Maybe we start with like sharing a little bit more about it, and then we can jump into the rest of the emerging manager topics.
Definitely. So I can start off with crossover itself. And so
Mhm.
crossover is an early stage venture fund with two different strategies in one vehicle. We invest half of our capital into emerging managers,
Mhm.
specifically who have an archetype of being a previous founder or operator, and are
Mhm.
leveraging that skill set to be able to pick, source, and win investments in the pre-seed and seed realm, for their portfolio. So typically call it funds one, two, and three. Our average portfolio median is about 40 million. And we back those emerging managers kind of with that archetype. I would say then the second part of our strategy is to come in at the Series A and Series B mark, sometimes alongside of our fund managers, to try to invest in one and two of their better companies. And the fun, sexy element behind our fund is that, while we're backed by the traditional mix of high net worth individuals, family offices, RAAs, etc., we also have accumulated about 45 professional athletes and entertainers who have invested with us. Rough breakdown of that cohort's roughly 15 NFL, 15 NBA, a couple tennis stars, one motocross guy, and a soccer player. Oh, and two actresses. And we really try to leverage that community, in a big way, to be, have to incorporate our wedge. And what I mean by that is we're throwing a dinner in different tech hub around the nation, once a month, bringing together a small group, curated group, about 18 people, to have innovative business conversations and meet interesting folks, not just from the fund to fund side, but from our founder side and from our LP side. We're huge believers in connectivity and that excellence of all backgrounds, and the kind of having that diversity
Mhm.
at the table is key. Because Grace, I know you've been to a million dinners of, maybe the theme is SaaS or fintech or founders or investors, and it's kind of all one ilk at the table, which is fine. But I think in order to get the best people out, having diversity at the table in terms of excellence is absolutely key and has been one of the keys to our success.
Love that. I wonder, so like, how do you think about, so like, I really love the dinner approach and then building the community with the NBA, NFL, um, LPs. And I wonder, so like, maybe we start with, I don't know if you want to talk about this, but like, I want to start with like, how did this fund started? Like, so like, who was the first like actress or like the NFL player that kind of like signed with the fund? And like, I guess like, how do you guys think about like, how much to raise as a fund? Because I feel like to invest in like as a fund of fund as well as like investing
Yep,
in Series A, it's like not cheap. So like it's not like I think for even
not cheap.
for entertainers or NFL players, like it's still like a very high risk asset. Like how do you kind of like think about the value proposition and then what type of like ICP as LP that you kind of shoot for to like make sure that they both understand the risk and the reward as well as like they are just like
Yeah,
comfortable or like having the ability to invest basically.
yeah. And just real quick, I want to address my background since I am in a jungle right now. My son was born 4 months ago, and so he's inside
Mhm.
sleeping, and we're down here in Puerto Vallarta visiting my father-in-law. And so while he's inside, I'm taking the outside office.
Oh my god, I just want to say the jungle is working. I like the jungle. Most people are sitting in the office are so jealous right now, but
All right, so that question was multifaceted. So I think I'll just start. So, kind of how did the athlete angle come to be? Talk a little bit about like kind of portfolio strategy, and then kind of
Mhm.
move on to talking about some of the risks associated with this model. Is that kind of the right?
Yeah, or like as a LP, how do you find like your LP? Or like I guess like since you guys are both GP and LP, how do you
Yep.
explain these kind of stuff to like the people who are investing and then what kind of risk tolerance level that they have to like or like maybe also like the filter on like what's your ideal LP for your fund too?
Yeah, that's a great question. So, taking a step back, if you look at our approach of having 50% allocation towards a fund to fund model and 50% allocation really towards a direct investment mandate, the key there is diversification.
Mhm,
I should have mentioned this at the top, but in terms of our strategy of the fund managers that we back, we really look for sector specific folks or folks who have interesting nodes of networks that they have premier access to and premier leverage to be able to source, pick, and win those opportunities. And so our pitch to our LPs is that at a high level, we are giving you the most diversified access to early stage venture. For instance, every quarter we are looking at the portfolio and saying, okay, how much coverage do we have in fintech, SaaS, AI tools, dev tools, crypto, Web3? And every quarter we have a look at the portfolio and say, this is where we are today, assuming that our fund managers continue in their allocation because everyone's at a different time in their allocation, where they're going to be at 100% deployed. What does our portfolio look like, assuming that happens? And then from there, I know the next quarter, for instance, I know I'm not going to make any more SaaS or
mhm,
fintech investments for GPs who are making those investments because we're over allocated in those sectors. I know, for instance, we'll have a more robust conversation about the macro environment and where we want to actually make our bets. So, for instance, Ken Sawyer, one of the GPs, longtime venture investor, longtime secondary investor, is really key about going to where folks are not looking. And so I'd say, right now, fintech, ad tech are very underlooked. I think before then, defense tech was underlooked. Now it's a hot topic. Before then, AI. And so we really try to look and see where are the eyeballs not going to, and where can we add further diversification to our portfolio for our LPs. So
mhm,
now incorporating that back into your conversation, looking at our portfolio, we really offer the most diversified access to early stage investments for venture, and that's
mhm,
pre-seed and seed. and that's all different sectors. And so we're consistently diversifying that. And if you think about kind of the direct investment approach as well, that's solely alpha. We're able to get our alpha through that. And so again, the pitch for any LP looking to enter venture is it's really tough. It's
Mhm.
incredibly hard to make individual direct investments into companies. If you look at a portfolio approach of 30 companies, 25 of those are going to fail. Maybe two of those are going to get your money back, and then maybe you'll have one outcome, 130x, 100x outcome that's going to return the fund. And that's venture in a nutshell. And I think at a high level, it's really difficult to pick those companies. And so what we're doing is we're saying, hey, listen, instead of you picking one company, you will have access to 1,000 companies through the crossover. And then from there, we're making select investments into companies that have aged a little bit more, have a little bit more seasoning, and are de-risked. So I think, to that degree, any investor who wants to get into venture in a diversified way, instead of hunting individual companies in which you need teams, you need expertise, and even if you still pick them, there's probably 1 in a 30% chance, 1 out of 30 of your companies are going to succeed. And so we solely offer anyone who's looking to get into venture, family offices, RIAs who want that exposure. Our model really resonates with those folks.
For sure. I wonder, so like since like a lot of the LPs have a lot of access to different VC funds, or like a lot of the funds they will, I guess, like having the access to high net worth individual themselves. Like I guess like what is the positioning for fund of fund? Obviously it's diversifying. So like instead of you investing like big time investing in one emerging manager, but you can invest in a lot of different emerging managers. I guess like what is a management process like comes in between? What's your deal like? I guess like evaluation process or like diligence process for the like I guess like these like VC funds too.
Uh, so do you want to just talk about just the underwriting process for various funds?
Mhm.
Would that be
Yeah, yeah,
helpful?
yeah, totally.
Okay, so I think, like I said at the top, we talk to about 30 different 30 different GPs a month who are looking for capital,
Mhm. Mhm.
and our box that we're hunting, the GP type, the archetype is X or current operator. So I think
Mhm.
right away, if they are a spin out, and I'm not saying those guys and girls aren't going to do
Mhm.
well and aren't going to be successful, it's just something that we don't concentrate on. And so
Mhm.
we solely focus on this X operator. So that makes our TAM a lot smaller to that regard. And we're
Can
able to
I ask
actually,
why is that?
yeah,
Like, I feel like that's such a unique model. Like, cause I feel
yes.
like whenever you're saying you're operator to like a traditional LP, they just like, oh, okay. So they want big fund spin off, but I wanted to like learn more about like what's a thought process behind it too.
Yeah, I think it comes down to, like I said at the top, Noah Lichtenstein, the main GP here at Crossover, he has been an operator himself. He worked with David Freeberg at the Climate Corp.
Mhm.
He ran and sold a company for 100 million bucks.
Mhm.
He went into venture, and myself, having worked in various prop tech and fintech companies, early stage, I think the strategy really is about at the earliest stage, at the ideation stage as a founder,
Mhm.
pre-seed, pre-seed seed kind of stage. Who do you want to work with? Who do you want
Mhm.
to have around the table? And I think for us, specifically, kind of in Noah's thesis, is that at
Mhm.
an early stage, it's so much more valuable to have someone who's made it, done it, been it around the table to
Mhm.
help ideate, rather than it is to have that first VC check come in from a
Mhm.
proper kind of established multi-tiered fund.
Mhm.
At the earliest stage, these X operators add so much value because they're able to talk about trials and tribulations, not just from a, how do I get my next series of investments, but,
Mhm.
how do I go through firing my co-founder? How do I go through missing board expectations? How do I go through acquiring my first customer and thinking about a VP of sales? And then, how do I go through, having a family, raising a family during a time I'm building a company? I think those are some of those questions. Obviously, traditional spin out VC folks can help with, but from an early ideation phase, we just felt that a someone with an operator background was much more valuable having around the table, and that the next, call it, billion-dollar companies will be seeded by those type of founders more so than traditional VCs. And so that was our thesis behind you know why hunt in that pool.
Mhm. Got it. Why don't we yeah, sorry, I block you from talking about how you're diligencing the uh emerging managers. Maybe we go back to that topic.
Yeah,
Apologize for the
yeah, yeah. No worries.
my child.
So credit is key. At every organization I've been at, whether it was FRB, leading capital markets, or even building out various op teams at Lending Home. I've always kind of taken the lead at building out the credit policy and the DDs and kind of what goes into the underwriting manual. And so, my first kind of year at Crossover was really about building out those processes, that infrastructure to be able to say, hey, from soup to nuts, how do we get a deal done? And what does it look like in terms of the due diligence process? And so at the high level, it's not much different than what everyone else does. You look at the market, you look at the investor, you look at the past track record. I think with specifically the folks that we're targeting, it's really hard to underwrite track record because usually this will be their either first fund or first
Mhm,
institutional fund. And so when that happens, we really have to look at A, their angel track record,
mhm,
and or B, whatever kind of track record they had before that. And I think specifically speaking, does what they previously invest in match the portfolio construction model and the thesis they have for this current fund? Is there
mhm,
a direct alignment? I can't tell you how many funds that I've seen where the GP is looking to raise or looking to put in 500K to 750K checks, but their historical track record shows that they've only been able to put in 50 or 100K checks. And how do I need to do diligence? Do I believe at my core that they're able to make that step up? And we do that through reference checks. We're extreme about our reference checks in terms of founders, in terms of colleagues, in terms of their network, to be able to assess kind of can they make that step up. Um, I will say kind of jumping from a lead check to a non-lead check. Sorry, from a non-lead check to a lead check needs to be due diligence heavily with the founders that they're working with. And so again, we spend a ton of time on reference calls. We spend a ton of time looking um, at how they're positioned at the network. And furthermore, I think the one thing we always hear, and I see this in every deck, is our access or our network is unique, and there's really no way to underwrite a network, of a
mhm,
person's network and how strong it is. Or, oh, I'm on a plane half the year in New York and London, and I have
mhm,
connectivity to both those markets. I'm in four different clubs here and four different, ex,
mhm,
Uber mafias here. And so, how do you underwrite that? And it's really, really difficult to, unless they have a track record, which a lot of guys and girls don't.
mhm.
So I think it's for us, we really resonate with folks who have an extensive angel track record, or this is their first institutional fund and they actually have maybe a fund zero to underwrite as well.
Totally. I wonder, so like for except especially when they have no track record, and then like how do you think about like I guess like because I feel like that's such a unique thing. It's because of like I think a lot of people are like, yeah, we don't invest in first time investors. We
Yeah.
yeah, and then
Yep.
like but if you have not worked at like a fund, I mean, even like let's say like, I've worked at like as associate somewhere, but like does that count as my track record? Or like do I have to be a partner to be like, oh, call it my track record? Like how do you even define track record? Also, like I feel like for the big funds or like for the I guess for the operator, it's like even tougher because a lot of people may have like you said, like, maybe they come from like the Uber mafia, like Kevin, like some people have great community or like a great network. But how do you kind of like translate that into like a LP language that people can
Yeah.
actually believe in what you're saying or like buying into it basically?
Yeah. So I think just to clear the air, we do not back folks who this is their first time full fund in
Mhm,
the sense that they don't have an angel track record or they don't have a fund zero. I think
mhm,
we're very much more suited to the fund, first institutional fund. Like I
mhm,
said, our median portfolio is about 40 million. I think
mhm,
the smallest fund we'll do is about 15 million. And, for a lot of our funds, we do require an audit, and
mhm,
audits can be quite expensive to where
mhm,
it's an LP expense, meaning it doesn't really make sense to have an
mhm,
audit unless you're at least 10, 12, 15 million AUM to be able to offset those costs. So anyway, uh,
mhm,
we're really, so, for interesting folks that I see who have, who we believe are going to have an interesting career trajectory, we put them on a watch list and we stay in contact and we maintain that relationship so that when their next fund comes around, we can potentially have a deeper conversation on, do we actually want to make that investment? And so
Mhm.
we're not the one-stop shop for everyone, and clearly by our operator thesis, not. But we really rely, like I said, really rely on at least having some track record and at least having some proof points in what they want to do and what they say they're going to do, to be able to look backwards and say we can actually, look at the breadcrumbs and see where they're going with this.
Totally. What is like, I guess, the smallest like track record that you have seen that actually raised the first fund? Because I think like because for angel investing, they're either like, so some people are writing big checks, but like with little amount of companies, or some people are writing like a million small checks, but in a lot of companies. What would you say are like the track record that you feel like are most like
Yeah.
interesting to you?
Yeah, I think so. Two things. One, we don't claim to know what archetype in terms of portfolio construction is going to be successful in this day and age of
Mhm.
venture, because of, you know if you look at how much venture has evolved over the
Mhm.
last 5 to 10 to 15 years,
Mhm.
ever since the 1970s when venture kind of first became an asset class. It's
Mhm.
evolved tremendously, and so we think that there's going to be a we're not going to claim that we know the exact archetype. So what does that mean for us? That means, in terms of our portfolio, we want to
Mhm.
have a cohort of folks, of GPs who actually lead deals. We want to have a cohort of folks that go for more of a spray and pray model. We want to have folks from different backgrounds, because
Mhm.
in our fund life, about 10 years after that, I think we'll be able to have a look back and say this archetype actually did better. But sitting here 2 years into the fund, I can't tell you exactly what portfolio model is going to be the
Mhm.
best. And so I think that's key. I think, whether when we're looking at when we're underwriting a GP, looking at their portfolio construction model, it it needs to match their background. And
Mhm.
so, again, if they've historically had a diversified skill set of being able to access, for instance, YC, and put 50 to 75K checks to work early, and they're making that step up to 250, that's a much more believable story for me than trying to lead deals at YC or lead deals post YC. And so I think also, in Kevin's structure, he's been, AI and ML, he's been in that field for a very long time.
Mhm.
He's well respected, and I think he has a different gravitas to where, he can command and lead deals where I think a lot of folks without that background can't. And so,
Mhm.
just because of his operator experience. So again, I think the portfolio construction model really needs to be dictated on the GP themselves and where their historical advantages have been and where they've seen the results.
Mm. Totally. Okay, so I wonder, so like for the people that you have, oh, by the way, I want to say hi to the audience. Hi, Miguel. Hi, Kent. Okay, so I wonder, like, how do you think about when you are, I guess, like when you are thinking about like their past portfolio, so like you mentioned like you don't invest in the first time, like you invest in first time like institutional managers, but you don't invest in like the people with actually zero track record.
Yep.
But what does the track record should look like before they started their first institutional funds? Does that mean like they have to have like five company that being picked up by like a later stage fund, or like what is a, I guess, like what should the track record even look like?
Yeah, I think what you're asking for, like, what are some leading indicators of success? And
Yeah.
so, if you look at, I think it's really important to look at, we do a ton of work
Mhm.
in terms of benchmarking track records based upon vintage. And so what does that mean? So there are various benchmarks out there, Carta, Cambridge, Adoro, AngelList, that have vintage benchmark performances for IRR, TVPI, and
Mhm.
DPI. And so, I think a first scan is like, whoever we're evaluating is how do they compare to the actual benchmarks themselves.
Mhm.
And so that's incredibly helpful to be able to see kind of how that individual is going to be doing.
Mhm.
I think from there, we really need to understand what is the GP's superpower. And I think kind of
Mhm.
depending upon the vintage, I think, being in the upper quartile is just kind of table stakes. Like that gets you
Mhm.
in the room. I think furthermore, what is their superpower and underwriting that. And there has to be some special sauce, either ex-employee, left a senior level role at a company of consequence and now is deploying in that capital, has connectivity to the YC network in some sort of senior coach type way. What's a data scientist at Uber? They have to have some sort of secret sauce. And I think that's just table stakes. And I think furthermore, it's really difficult, especially with like the 2022, 2021 vintages, because the amount of markups were so slow compared to kind of what happened leading up to like May of 22 when we were kind of in that bubble. The time that it takes for a series A, from a seed to a series A, has elongated substantially. Therefore, folks in that vintage, it takes a while for that TVPI, that IRR results, to really kind of hit that hockey stick, because it's taking longer for those companies to get written up. And so I think, when we look at those vintages, like what are the leading indicators that we look for if the results in terms of IRR and TVPI aren't there? And I think, looking at some of the co-investors who are around the table. So who led kind of the deals in which they are entering. And then furthermore, when a follow-on does happen, or there's another round of financing within that company, it doesn't have to be a priced round. It could be a safe kind of who's coming in, who's leading those deals, and how much capital are they putting to work relative to their average check size. For us, it's really great when you see a GP, go above their mean check size into companies, and you see the results in terms of markup, or you see the results in terms of follow-on investors. And those are just early indicators of success. Obviously, like, this is a long road. DPI is the ultimate success, but that's 10 plus years away. And so I think we look for co-investors both at the follow-on stage as well as the initial investment stage, to be able to make that determination of kind of, are they in the right rooms, are they meeting the right people?
For sure. I wonder, so like for the people who you have invested in, like, so obviously, like, I know, chapter one, I think, well, Jeff went on our show before, so I'm pretty sure that's like a solo GP fund too.
Yep.
Or like, yeah, like, and then like, so is this like solo GP a must for you guys, or do you guys like do, like more of like, people building out like the whole
Yeah.
firm and like doing all that kind of stuff, or solo is a
Yeah.
kind of like a preferred way?
I would say our model of trying to find and invest in this previous operator kind of turned VC is more akin to a solo GP model. But that being said, we do have a couple funds within our portfolio where there are multi GPs, which we think is not necessarily a bad thing, but we just think it's good to have that diversification. I think for us, I think we made 3 or 4 fund investments last year. Looked at a couple thousand decks, had a couple hundred meetings. And so I think what it really boils down to is, when you're adding more GPs in the mix, the underwriting, you're also underwriting partnership risk. And so have these folks work together, because at the end of the day, putting a check to work is great, but we really want a multi-fund relationship. We're not really a one and done type shop. We would hope to be able to earn the right to be able to invest in fund 2 and 3 and 4. And I think what's challenging about the multi-GP funds is that, especially folks that haven't worked together, you really have to underwrite the partnership risk of breakups and what that means for the fund. And again, it's a lot of work to find, underwrite, and invest into these, very accomplished GPs out there. And so we don't want to continually be able to do that. We would much rather have folks that we can have a multi-fund relationship with. So it's not a deal breaker by any means, but it does add that kind of partnership risk aspect to our underwrite.
I wonder, I totally feel you. And then I wonder for the check size, like, what's like, since like you mentioned the median is like 40 mil, like,
Yeah.
you guys lead as like their, like, I guess, lead investor for the fund, or like do you guys do, or like, I mean, slash anchor investor, I guess. So like, or do you guys do like, I guess, follow on as a LP too?
So I think we are not an anchor investor ourselves into these funds. Just due to our current fund size. I think, moving forward, that's something we may look into. Some of our GPs, they invest at pre-seed seed stage, like pre-seed early stage. Some of our investors that we invest in, like, lead series A. So there's a big dispersion in terms of portfolio strategy and what folks look at. And so again, we don't know exactly where true value secretion is going to happen for the next 10 years and kind of what cohort that's going to be, which is why we're taking a diversified approach, which is why this is key to be able to talk to our LPs who are investing in us and saying we're offering the most diversified look at venture as a result.
For sure. For your fund, are you raising from institutionalized capital, or do you just primarily do like family offices or like high net worth and stuff?
I think for fund one was primarily concentrated on high net worth family offices and RIAs. I think, for a subsequent vehicle, it will be more institutional focused, as well as kind of
Mhm,
bringing on those key strategic community relationships. And
mhm,
so, for instance, the WNBA are folks that we want to get more involved in our fund kind of moving forward. We want to have more connectivity to F1 and really broaden
mhm,
some of our sports base that has been successful in terms of
mhm,
being a differentiator out there in the market for us as we're meeting founders and as we're meeting GPs. So I think, yes, we were going more
mhm.
institutional, but also wanting to broaden our base for our community as well.
Mm, I wonder, so like I wonder, so like when you're looking at these like 120 different fund managers, I guess like can we walk through maybe any of your portfolio company slash portfolio fund as an example on like how you are like working with them, or to like I guess like to make up your decision. So for example, let's say I don't know, I really don't want to pick on Calvin, but like let's say like anyone who's like within a portfolio that you think it's like, for example, how do you meet them to like what kind of diligence process? You mentioned about like the underwriting process. What does that even look like? And is that like you building out their fund model based off like how much they have invested in and in what company and then in like what kind of result that is? And then you compare like I want to say fake, but it's like an imaginary or like prediction vibe of like DPI or like whatever to compared to like these other folks, or like because I think the question whenever, let's say if like a LP asks you about like, hey, like can you like what's your like outcome of your fund? I don't really think anyone ever really asks this question, but like when people are thinking about like, what's the ideal outcome of your fund? Obviously, for everyone, it's like the most optimal is like, you hit like five unicorn
Yeah,
of
yeah.
the 40 portfolio company that you invest 100K in, and then you like, 20x your fund or something. But how do you think about like what is actually happening when like, your fund, like what's a realistic prediction for like any fund one? Or I guess like would that even be a question when LP check these emerging manager, that would
Yeah,
they even ask
yeah.
this?
I think I think I get what you're trying to say. I think, for the most part, we underwrite to at least a 3x net, and that's our
Mhm,
hope, is that at least a 3x net will be the outcome of this GP's portfolio in,
mhm,
honestly, 12 years. It's a 10-year fund, but realistically, two extensions probably
mhm,
puts them at 12, maybe even longer in this environment. And so that's what we're trying to underwrite to at the end of the day,
mhm,
is like, can they hit that? We similar to
mhm.
our sports athletes, we don't use their name, image, and likeness for marketing reasons. So I'm hesitant to use any individual one fund or company as an example. But
Yeah.
like I'd say, like a typical like underwriting process is, they get in the funnel, top of funnel, and whether that's usually kind of the highest conversion rates always by either intro through a warm intro through one of our LPs, warm intro through one of our GPs, or warm intro through a founder that we currently back. I want
Mhm,
to say that maybe 75% of the deals that we've done have come through those channels. We have not had one deal come through in which it was a cold inbound. And I can't tell, like, for folks listening on the show, like, if
mhm,
you're sending an email to a 1-800 number, just don't bother. Like, that's not an effective use. The best thing you can do is find a mutual contact to get you access to that decision maker to have that
mhm,
conversation. And so, kind of top of funnel, that's how they come in. We do spend a little bit of time underwriting kind of the credibility of that source, and like how, obviously they're bringing it to us. We've hoped, through these referrals, is like they already
mhm,
know us, crossover, what we invest in, the type of GPs or founders that we're looking for. And so there's already like a filtering that's done at that
mhm,
level, whereas kind of cold inbound, there's no filter. And so that's kind of step one. It comes into our process. I think, the first thing we do is, look at the deck, evaluate track record, or request track record and understand kind of what is special about this fund. We then kind of take those observations to our investment committee and present that to them. From there, it's, if we don't have the track record, we run our track record through our model, do some benchmark comparisons, evaluate the companies, follow on investors. And then from there, I think now comes the investigative work where, we really look to say, what are the crucial questions that I need to dig to understand, is this fund going to be a 3x plus net type fund? And so that could be in a multitude of different areas, whether they have access issues, whether the founders, whether the networks that they're actually in have historically produced great outcomes, or in the future, do we believe that as well? Or it could come down to like double clicking on the portfolio model and testing that out to make sure that, based upon the track record of the individual, if we apply that now, how does that look in this environment? Because this environment's very different than 2021, very different than 2017. And so I think, every GP is a snowflake to that regard. And so we're really trying to figure out what those underlying questions are. Then from there, I'll go back to the GP. We'll have a broader meeting in person or Zoom meeting where we'll try to get those answered. And I want to say, then going back to IC, presenting that to the IC, talking about A, B, and C, this is what we uncovered. And that may uncover a whole new list of questions. And so I'd say in Kevin's case, we're just picking on Kevin, I think it was about a 3.5, 4-month underwrite for him. And so, that was back and forth, looking at the data that he provided us, back and forth with our investment committee, trying to understand what are the crucial questions that we need to get to. And the nice part about our process is that during our IC meetings, we're very particular on like, hey, if this is a no, we're fast at getting back to folks. And I don't know if folks on your show have talked about this, but, venture is so divided in terms of etiquette and getting back to folks. And so we really, I think, even spend too much time. And I learned this from Noah, who's done a fantastic job of this. We probably spend way too much time detailing why we do not do investments with folks. We're very big believers that that's, full circle will come around and B is the right thing to do. And so we're fast to get to a no, and we don't like to string people on. And whereas I can't say that's true for the rest of our industry.
I have a question for you. So, like, for example, let's say if emerging manager come to you,
Yep.
with like a really good like mock portfolio. So because like a lot of operators, they may not have like a lot of cash on hand, especially live in Silicon Valley, everything is so expensive. And I wonder, like, let's say they came to you, they're like, hey, we actually had access to, here's a list of company, right? Like 30 company or something.
Yeah.
And then, but like, we just didn't have the money to invest. And then you can diligence by, I don't know, calling these people on the list or whatever. Like, would that be a hard no? Because it is not their portfolio, but they do have access. But everyone can claim that they have access. But
Yeah.
what is the vibe on that?
Yeah. I think to be successful in this business, you have to, it's sales at the end of the day. And so if you're having trouble selling to LPs to raise money, why you should be in a capital allocator seat, and trying to convince us that you have really good sales techniques and can win deals from the founders, but can't do that, it's hard for us to make that jump and say like, this is an actual investment opportunity that we'd be excited by. I think furthermore, like just the glut of emerging managers who are out there right now, I think their last count we had was about 4,500 folks with funds who are actively in market, emerging managers, funds 1, 2, and 3, who are actively raising in market right now. And so I don't think, the access to finding new funds, access to underwriting new funds hasn't really been our issue. And so I think we would only look at that strategy if we were having trouble finding great funds to invest in.
What would you say are like, let's say if a person pitch you on a generalist strategy, you mentioned about like you have like the portfolio
Yes.
founders that are doing like, very niche stuff, right? Or like a very,
Yeah.
I guess like expert in a particular area. But if a person come into you, be like, hey, I mean, again, using like Uber as an example, I don't think this is Kevin because Kevin is a niche expert, but like I would say like not niche, but like it's a right now AI become a very popular niche. But like I guess like when a person come to you be like, hey, we're early Stripe employee, and then here's like we're only or like early OpenAI employee, and then we're gonna invest in like every OpenAI person's company or whatever. And then if that's a strategy, instead of like having a very specific approach about like, hey, we're only going to invest in, I don't know, dev tool coming out of
Yep,
OpenAI community. um What's your reaction on that? Because technically everyone coming out of OpenAI can have the same network with this guy or girl. How do you think about if a person coming from a pedigree, but that's kind of like
totally.
also a generalist?
Yeah, first and foremost, we have nothing against generalist funds.
Mhm,
We think they're going to be fine. I think they're going to perform well.
mhm,
It's really just a question of our own strategy. And so,
mhm,
if our main goal is to provide the most diversified access to early stage
mhm,
venture, it's really difficult to do that from a generalist approach because we could get more overlap within our fund managers in our
mhm,
portfolio. And
mhm,
furthermore, who's to say one individual sector is going to be the best fund returns for the next 10 years? And so,
mhm,
hence, we want a diversified approach. And so, we think for our portfolio model, for what we stand for, that it's easier, it's better for us to pick folks who are either sector specific or network specific, to
mhm,
where they have an advantage to source pick and win the best deals from there, rather than the generalist GP.
mhm,
I think at a higher level, our belief is that, value secretion for venture, what it looks like today,
mhm,
moving forward, we think it's going to happen to two main contributors, and that's the tier one multi-stage funds, which we all know, uh, the Sequoias, Andreessens of the world. I think that, and also on the other side of the benchmark are going to be, these small, agile, sector specific uh, GPs who are solely kind of sub 100 million. We think that those guys and girls are going to be incredibly successful in this new age of venture. You got to
mhm,
think about it, because like the fund to fund model is not new. It's been going, I
mhm,
mean, since 1970s. It's been out there. But what
mhm,
is new and innovative about the space is the rise of seed investing and the rise of the angel investor, which happened, call
mhm,
it 2010 to 2015. And so
mhm,
our entire fund model is predicated on backing and institutionalizing these super GP,
mhm,
super angel investors with sector or network specific focus. And so, therefore, long-winded way of saying, the generalist GP just doesn't really work for our model. That's not to say they're not going to do well, though.
totally. Okay, so how much does like fund management slash management fee supposed to look like? So for example, let's say you have a $10 million fund. Shouldn't you just shoot for to like invest in like 8 million, because 20 I mean the other 2 million should be your like 10-year management fee? Or like how do you like, I mean, how much does like the lawyer thing is gonna cost, or like everything else? Like what is there like a normal standard ratio for that? Or like is it just like based font up like based off like the font strategy and everything? It's like everything varies.
Yeah, I mean, I mean, it's pretty general, broad strokes. I mean, the fund to fund world is really kind of more coalescing at like a 1% management fee. The direct investment mandate I've seen kind of in the two, kind of more moving up to the 2.5% kind of range. And obviously, it's really contingent upon the experience of the GP.
Mhm,
Folks who have had larger exits, or are currently sitting in an operator seat, for instance, or still operating in a company, may not need those fees to offset kind of their day-to-day expenses, into which case that
mhm,
management fee may be smaller. Um, Other folks who haven't had those opportunities or those exits, or are not sitting in those seats, may decide to juice up their management fee to kind of cover
mhm,
expenses. I think also what's really interesting is trying to understand the ambitions behind the GP. And so, what are they actually using that management fee for? Is it to hire additional team members? Is it to improve the sourcing? Is it to improve their community? Like, kind of what's going on there? And so, I
mhm,
think it's really important to understand day one, what
mhm.
is the ambition behind your GP and what are they trying to do?
For sure. Okay, so I want to be mindful of the time. Maybe we do one real question and 1 minute fire run.
Yeah,
Okay. So real question is like, okay, so what's your outlook on the emerging manager market in general? Like because I personally feel like there will be a wave of merge, because I think running a fund is actually really
yep,
hard, and then it takes a lot of time to even do the admin or like management of the fund,
yep,
hiring people. A lot of like emerging managers, they're great solo GP slash like I guess like top super angels, but like they're not like I don't know, like not everybody's building a fund, right? So like how do you think about like what's the future of that? And then do you like right now we're in like a emerging manager crazy hype era as like I mean I don't think we're even in the hype era yet, but like right now a lot of people are emerging managers or want to be emerging
Yep.
managers. What's your like advice for them?
Main advice to anyone starting a fund is to lean into your superpower, whether that's your network, whether that's your previous operating experience.
Mhm,
Like, what makes you unique? I can't tell
mhm,
you how many decks that I see where it's not even in the first 5 slides that
mhm,
it's not evident why you and why now. I
mhm,
think if you're able to answer those two questions early in your deck and really say like I'm the right person for this because of X, Y, and Z that I've done in the past, and I have this unique insight based upon my experience, and this is the market I'm tackling. I think
mhm,
that's really special, and I think that's when we talk about what is your superpower. And so,
mhm,
having an articulated elevator pitch on what your superpower is essential.
mhm,
And to answer your first question on kind of my outlook on the venture or early stage landscape is, there are a ton of vintage 2021 and 2022 funds out there. And I think
mhm,
it's going to be really difficult for those folks to raise subsequent funds just because of the environment which they raised in, and especially having a fund one where there's just not much proof points to be able to say that they've earned the right to be able to have a fund two. And so we do think there's going to be some downsizing in terms of the ability to raise subsequent funds from that cohort. But long term, we're fundamental believers that the world is going to become more divided in terms of the 1 billion plus AUM funds and the under 100 million AUM funds. And you're seeing that today with all the spinouts from top tier VCs. Folks are spinning out and creating their own VC fund. And
mhm,
so we think this is a long-term asset class that we want to play in and we want to be in. But we also see kind of there are some challenges with that 2021 and 2022 vintage, especially folks that have raised a first time fund, even 2022.
mm. Okay, quick 30-second fire round. What's your favorite book
Oh, ever.
ever?
So I'm reading Patterns right now.
Mhm,
My Mike Maples. It's a
mhm,
fantastic book, and I think for anyone who's trying to get into the business of venture, it's a really interesting understanding of kind of where value secretion is in terms of finding founders who have some sort of superpower and really underwriting the founder at the earliest stage. And so it's more applicable into my new era of where I want to be.
Mike is in my book. Mike was an OG. Yeah. Okay. So what?
Have you read that book, by the way?
I wrote these
Pattern
two
Breakers?
books. Pattern Breakers. Yeah. Like I went to Mike's like signing by
Mm,
HSBC, and like it was pretty good. Yeah, I haven't finished yet, obviously, but like I really like his storytelling about like how he meets he's like lived and stuff
totally.
like that. Yeah. So who made the biggest impact in your career?
Probably my wife, to be honest with you. I
Mhm,
think having the support system of a partner who supports you, holds you accountable day in and day out, and that you can have
mhm,
an open dialogue with more so than you
mhm,
can with a mentor, more so than you can with a family member.
mhm,
Um, she's been incredibly impactful to who I am today.
mhm. Who would you invite to a dinner party?
Who would I invite to a dinner party?
Mhm.
Dead or alive?
It's your party?
Well, man, our current success rate has been inviting kind of 1 to 2 of our athlete LPs, 1 to 2 kind of founders of consequence of billion-dollar companies, and then kind of other executives in the room. And I think that the conversation between someone who's been really good at sports, like a Kobe Bryant, for example, would love to talk
Mhm,
to him because of his Mamba mentality.
mhm,
Sitting across from Mike Maples, sitting across
mhm.
from some early stage founder who's really killing it. I think would be really really interesting. Just having that diversity of conversation.
Totally. Okay, so where can we find you outside of work?
Yeah, outside of work, you can you can find me running on Crucy Field in San Francisco in the mornings, or along the Embarcadero.
Amazing. Well, Miles, thank you so much for coming to the show today. I know you have a hard stop, but let's catch up soon. You're the best.
Thanks.
Thank you.
Appreciate it, Grace. Thanks, everyone. Cheers.
Let me quickly end stream. Sorry.